Some big tech names getting left behind in the market rally today, including Nvidia and AMD, is coming after the chip giants laid out their AI roadmaps at CES on Monday. So what does this tell us about the outlook for the AI trade? Joining me now, we've got David Stubbs, AlphaCore Wealth Advisory Chief Investment Strategist. David, great to see you. Let's start on that AI theme, David, because you seem to suggest here you think this AI boom can continue. Why do you say that, David? What gives you the confidence, especially, David, as some well-known strategists have been telling their clients, I know, hey, they think some AI fatigue seems to be setting in here.
Well, great to be with you. I think it's AI evolution rather than fatigue. I think there's two kind of pathways to a further boom. One is the continued build out of the CapEx cycle. Look at the tightness that still exists in data center markets. Look at the tightness that still exists in energy markets. So AI direct CapEx and related CapEx, we still think is going to be a significant driver to the economy and markets really for the next 2 or 3 years. And then, of course, is the evolution point is the market rewarding firms which deploy AI and drive margins through it. And there's many, many firms that can do that in the next few years. And you see, for example, the strength of financials recently, and I think that's a sector where they have a lot of proprietary data and a lot of regular processes on the back end that can be automated. So there's all types of ways for the AI boom, I think, to evolve from here and continue to be the marquee driver of the economy and markets really for the rest of this decade.
And so let me ask you, Dave, if I'm a viewer and I'm following along on this AI evolution, how am I picking my spots here? How am I discerning winners and losers? I mean, is the way to do that? Do I look for, David, the names that, okay, they control the whole stack, right? I look for like a Google. I mean, Sundar Pichai, he's got the chips and the cloud infrastructure and the distribution. Is that what I'm looking for?
That's certainly one way to go for sure. I think there's a number of ways to play it outside of buying, obviously, the marquee names in the chip space. Not to say that they won't do well. I think you could target any company with a low revenue per employee. That usually signals that they've got quite a significant number of employees, and potentially they can grow in the future without adding more. I think energy is a great way to play this. We have a shortage across the board. We have an evolving energy landscape across electric vehicles, across energy supply. And this is the important thing, is that in the S&P today, only 2.9% of the market cap is energy. So this is a theme where it's actually quite hard to play unless you really try. You could go to the high yield market, but only 11% of the high yield market roughly is related to energy. I think the best way to play energy right now is in the private markets. Look at private infrastructure funds which specialize in energy, or maybe a data center play. There's some large names, obviously, internationally as well across Europe in the energy majors as well. So we like the energy theme because it takes a little work to get it. Right now, you don't need to work to play the tech theme. You could just buy the NASDAQ and you can buy the S&P. But the energy side of things, while it takes a little calibration, I think it's an area that we are very excited about.
You talk about investing overseas as well, David. You emphasize Europe and Japan. What has changed there, David? What makes them more compelling opportunities right now?
Well, I think the starting point for us is that international diversification is a linchpin to wealth preservation and growth in our view. We're fully aware that in liquid markets, you've seen an outperformance over the last 5, 10, 15 years from the United States. That has produced in liquid markets a valuation gap. Now, that gap can be explained by differences in sector composition and differences in return on equity. But I think if you're trying to generate income, if you're trying to play a theme like energy, if you're keen on what you're seeing out of the reform story in Japan and India, if you believe that certain structural weaknesses that have been present for a long time, the obvious one is European banks are no longer structural weaknesses. I think there are key themes you can play around the world in international markets. I think when you go to the next level, you can point into the private space and into the alternative space and focus on markets that in, say, private equity are less competitive than the US, private credit less developed than the US as well. And then in things like infrastructure, you can look around the world and see countries still building out the basics of infrastructure, a great complement to the digital infrastructure boom you see onshore here. So look, we still believe that US markets are going to perform well. They're going to be the core of wealth management portfolios in the United States. Of course they will. But I think people running a solely US portfolio should consider how high the dollar is, how attractive some of the themes internationally are, and work with their managers to get that exposure.
What's your advice, David, for fixed income investors?
Well, mainly to focus on relative value strategies. We are not seeking a huge amount of interest rate risk in this environment. Now, that's obviously an interesting thing to say with the Fed cutting 3 times already. Arguably, you're going to cut more this year, the market pricing in a couple of cuts. I think it's perfectly reasonable if the unemployment rate stabilizes. If it doesn't stabilize, we're going to get a lot more than 2 cuts. But lower rates at the front end do not necessarily mean lower rates at the long end, and we've seen a lot of stability, there. What matters most, I think, for fixed income investors, especially in a multi-asset context, is what is the fixed income going to do if the equity market sells off, and no one knows the answer to that question. And because you don't know the answer to that question, unlike in the 2000s, 2010s, where it's quite clear you would get a rally, that's why it's harder to move into the interest rate risk. I think that all-in yields across both EM and across corporate fixed income are reasonably attractive for income investors. And I think that those people who despair of active management, whose S&P large cap active fund can't beat the index in fixed income, there is a lot of alpha to harvest. And I think that's also a good way to lean in and create a little bit of extra return there.
David, good to see you as always. Thank you, sir.
My pleasure.
Let's start big picture, Byron. All right, you think about that great AI trade and trend, which you know very well, longtime investor as you are in that theme. I'm curious, Byron, how you see that evolving now in 2026, Byron. How is it going to compare and contrast to 2025? What's going to be different?
Josh, great to be back with you. Always fun. And I do think we're entering this next phase of the AI transformation and therefore the AI trades. And that is all about AI software. The earlier phases were about the hardware stocks, the Nvidias, AMD, Broadcom, not to mention the data centers, the hyperscalers, et cetera. But really it's transitioning now to 2 phases of software. The first is the networking and the software stack that's going to accelerate and amplify these infrastructure build-outs. If you think about NVIDIA's strength, it's always been end-to-end. It's the silicon, the software, the libraries, the networking stack. Others are entering that game now, and just one example, AMD has partnered with our portfolio company DriveNets on the networking and the software stack, and they're already showing higher performance in tokens per second, per watt on a cost-adjusted basis, which is one of the signals that more competition's coming. And I think that's good for the market. And we're going to see software unlocking a number of NVIDIA competitors to be competitive in these ways. The second software angle is upstack, the platforms and applications that this great infrastructure build out is going to unlock. And if you think about the $550 billion annual run rate we're at now in CapEx, going to $1 trillion shortly, that carries about a 9x multiplier in terms of software enterprise value that enables. And that's what we're going to see as the investable trend in the coming years, about $45 trillion of potential software market cap if you believe this CapEx build out that people are talking about.
Let me ask you, Byron, a debate that also continues is whether we are in some type of AI bubble. And I'm just curious how you think through that, how you even define bubble, Byron. Are we in one? What would be the signs and signals that would indicate to you we're in one?
So we look at demand first, and we are in this massive buildup and wave of AI compute demand. However, we are still compute constrained, which means as prices come down, capabilities go up, you're seeing more and more use cases be unlocked, which in my mind shows that we're just scratching the surface in terms of what AI can do and means for the market. Now, the bubble term also often comes with multiples and prices, and absolutely these businesses are being priced at forward numbers and being priced to perfection, especially in the private markets where you're seeing multiples deep into the tens and in some cases, 20, 30, 40, 50x short-term revenue run rates. But it's also because you're seeing these businesses grow at rates like 400% a year. And we're starting to see mind-blowing things again, where you see demos that were never before imaginable. You're seeing, medical use cases where lives are going to be saved and outcomes are going to be, transformed for the better. You're seeing education where people can have personal tutors, and in physical AI and robotics where, Waymos are becoming mainstream in robotaxis, and you're seeing robotics use cases. And so I do believe that money's going to be lost and there's going to be some carnage along the way, but net, we're still in the early innings, and the value creation and enterprise growth that we're going to see ahead is a multiple of what we saw in the last compute cycle of cloud.
You mentioned Nvidia earlier, Byron. I know you're a venture investor, but I am curious to get your take on that company. CEO Jensen Huang at CES this week was making some headlines and news. What do you see ahead for Nvidia?
Yeah. They continue to set the standard. Immense respect for Jensen and what they've built, and many of our companies are big customers of theirs. But I do think that competition is building, and what you're going to see with this pairing now of software and networking capabilities with the other silicon, not only from AMD and Broadcom, but also from the hyperscalers, their own capabilities, you're going to start to see more and more competition, which is net very good for the market. We're going to have more offerings, and again, you're going to see that as this compute comes online for both training and inference, you're going to have much more capability. And I think you'll start to see the demand equation balance out a little bit, and continued pull through as more and more use cases start to become available as that cost curve comes down.
What about traditional SaaS companies, Byron? That's another area you know very well. How does 2026 look to you?
Yeah, so there's been a lot of selling pressure there. And, I view it as oversold but not obsolete, meaning that there's going to be a separation. And I think the public investor money to be made is figuring out who's doing AI washing. And granted, there are a lot of companies out there that are sprinkling this AI pixie dust on their story, and they're working really hard to look like an AI company, but fundamentally are not. Separate them from the companies that are really embracing and leading in this next wave. And I believe you're going to see this reacceleration of their businesses and these kinks in the growth curve that start to reflect the AI proposition. So for the public investors, first principles diligence into their supply chains and customer pull-through is going to be the indication there. For us on the private side, we're seeing it, daily in the reporting, and companies like Canva that have reaccelerated and are starting to talk about what is possible when you drop in AI deeply into their business.
Let's talk about the IPO market this year as well. By my friends at Barron's reminding me here, 202 companies priced IPOs in 2025. They point out a 35% increase from the prior year. What do you expect to see this year in 2026, Byron? How will it compare and contrast to 2025? Stronger, weaker, the same? And what are the variables that depends on?
I wish I had better news to project here. 2025 was an uptick, but from some very bad numbers. And if you look in aggregate over the last several years, it's largely been record-breaking to the negative side in terms of underwhelming and pretty lousy in terms of total value creation. And you pair that with what is the single best deal pipeline in history. There is amazing high quality, large scale companies waiting on the private side that aren't yet flipping over. I do think we're going to start to see a little bit of an unlock there, but the names that people are tracking, the OpenAIs, the SpaceXs, the Anthropics, the Canvas, the Stripes, I don't think they're going to blow this door wide open in 26. Maybe a couple of them do start to touch the public waters. Maybe a Databricks joins that group. But really, I think it's going to be late 26 that sets the stage for 27, which could be a fantastic IPO year. However, on the M&A side, I'm much more bullish, and I do think existing public companies are going to need to respond to this AI pressure, and we could have a record year on the M&A side.
Finally, Byron, I got to get you out of here on this. Listen, not only a very well-known and respected venture investor, we should point out a partner and owner with the San Francisco 49ers, my team I grew up with. Eagles.
Go Niners, thank you.
Eagles, Sunday, the keys to victory, Byron.
Oh, get our healthy team on the field. We've got the talent, and the injuries this year have been brutal. And so we'll get some more guys back this week. If we're fortunate enough to extend the season several weeks, as I predict we will, we're going to get some additional players back, and we can play with anyone when we're healthy. So fingers crossed we get the chance to do that.
Byron, as always, great to see you, my friend. Thank you.
Cheers. You as well.